Forex trading can seem complicated, but it's simpler than you think. Imagine you're swapping currencies on vacation. You trade your dollars for euros. Later, the euro's value increases. You trade back and make a profit. That's Forex trading in a nutshell. You're buying and selling currencies to potentially make money from the changes in their values. It's like a global marketplace operating 24 hours a day, 5 days a week, where currencies are constantly being traded. But unlike your casual vacation exchange, Forex trading involves something called leverage, which can amplify your gains and losses. Leverage is like a loan from your broker. It lets you control a larger trading position than your account balance would normally allow. Think of it as a multiplier for your trades. Let's say you have $1,000. With 10-to-1 leverage, you can control $10,000 worth of currency. This can magnify your profits. A small price move in your favor translates into a larger profit. But remember, leverage is a double-edged sword. It can also magnify your losses, potentially exceeding your initial investment. That's why understanding leverage is crucial before you start trading Forex. Leverage can be particularly attractive to beginners who are just starting out in the Forex market. It allows you to enter the Forex market with a smaller amount of capital, making it more accessible for those who may not have a lot of money to invest initially. This can be beneficial if you're new and want to test the waters without risking too much of your own money. It provides a way to gain experience and understand the market dynamics. For example, you might want to trade EUR/USD, but it typically requires a large position size that could be daunting for a beginner. Leverage lets you participate in this trade with a smaller amount of your own money, thereby reducing the financial barrier to entry. This can make Forex trading more accessible and potentially increase your returns, as you can control larger positions with less capital. However, it's important to remember that leverage doesn't change the market's behavior. The Forex market will still move in the same way, regardless of whether you are using leverage or not. It simply magnifies the outcome of your trades, whether positive or negative. This means that while your potential profits can be higher, your potential losses can also be greater. Section 4. Risks of high leverage, a beginner's nightmare. While leverage can amplify gains, it's essential to understand the risks, especially for beginners who are just starting out in the trading world. High leverage can quickly wipe out your entire account if the market moves against you, leaving you with nothing but regret. Imagine using 50-to-1 leverage on a $1,000 account. A small market fluctuation can have a massive impact. A small market move against you could lead to significant losses, potentially exceeding your initial investment and putting you in debt. Beginners are often lured by the promise of quick profits with high leverage, dreaming of overnight success. However, this can lead to impulsive decisions and substantial losses, turning dreams into nightmares. It's crucial to prioritize risk management and use leverage responsibly. Educate yourself, start small, and always have a plan. Section 5. Finding your Forex leverage sweet spot. So, what's a suitable leverage level for beginners? Most experienced traders recommend starting with lower leverage, typically 10-to-1 or even lower. This provides a balance between potential profits and manageable risk. For example, with 10-to-1 leverage and a $1,000 account, you can control a $10,000 position. This allows you to participate in the market while limiting your potential downside. Remember, it's better to start small and gradually increase your leverage as you gain experience and confidence in your trading strategy. Section 6. Conclusion. Trade smart, start small. Forex trading offers exciting opportunities, but it's crucial to approach it with caution, especially as a beginner. The market can be volatile, and without proper knowledge, you can incur significant losses. Leverage can be a powerful tool but requires careful consideration and responsible use. It can amplify your gains, but it can also magnify your losses if not used wisely. Start with a demo account to practice and understand how leverage works in different market conditions. This will help you gain confidence and experience without risking real money. Choose a reputable broker, educate yourself thoroughly, and never stop learning. Continuous education is vital as the market trends and strategies evolve over time. Remember, consistency and risk management are key to long-term success in Forex trading. Develop a solid trading plan and stick to it, even when the market gets tough. Trade smart, start small, and never risk more than you can afford to lose. It's better to grow your investment gradually than to take unnecessary risks. Good luck on your Forex trading journey. Stay disciplined, stay informed, and may your trades be profitable.